this is the capital rotation indicator. You'll see a sort of matrix in the top left-hand corner there. And what's in those red boxes is US money supply, which is in a bear market versus gold. DXY is in a bear market versus gold. Then we've got gold breaking out versus CPI, PPI, currency in circulation, the equal weighted S&P, NYA, which is the New York Composite, the Dow Jones, the Wilshire, the Russell. And gold is breaking to a bull market versus the S&P and NASDAQ at the moment. And there's a little bit of a caveat on that. It probably just needs to fall a little bit further to give ultimate confirmation.
Hello, GoldSilver family. Alan Hibbard here with another video, and today I'm sitting down with the co-founders of Northstar Badcharts to discuss the capital rotation event and what it means for gold and silver. Kevin and Patrick have joined me, and they're going to talk about the significance of all the capital in the world moving from the stock market into gold and silver and what that's going to mean for the next few years. So Kevin and Patrick, thank you so much for being here.
Alan, thanks for inviting us on the show. It's good to be here.
Yes, thanks, Alan.
Before we go any further, let's discuss what a capital rotation event is and why it's so significant for people. It's my understanding that the average person might only see one or two of these events in their lifetime, and yet it's a tremendous opportunity to attain wealth. So what is the capital rotation event?
Yeah, sure. Well, the term capital rotation doesn't just apply to stock markets and gold. It applies to movement of capital broadly between different sectors within the investment landscape. Really, it could be, any kind of movement of capital that you can track using technical analysis. Essentially, you can compare one chart with another and spot these ebbs and flows in the markets. That's capital rotating away from, for example, technology stocks to perhaps resource stocks or whatever it happens to be. So the term capital rotation isn't anything new, but if you can spot when there's this turning point in history between precious metals and stock markets, and it doesn't happen very often, it might only happen once every 20 years or so. If you can catch that in the early stages, either when it's rotating away from precious metals towards stock markets or in the opposite direction, then everything else comes from that. Pat described it as the Rosetta Stone. And that's kind of what it is, because once you get that right, then everything else flows from that. When this ratio chart is moving upwards, it means gold is outperforming the stock market.
Yes.
And when this ratio chart moves down, it means that gold is underperforming the stock market. So that black line on the top chart there, that's tracking whether gold and precious metals and commodities are outperforming stock markets or whether they're not. And because this is a huge cyclical process that takes place, it's like trying to turn an oil tanker. You can't turn it on a dime. It takes a long time to turn. So you get years to spot the turning process. And then when the confirmation comes in, that's the time to really go strong in the right direction, either stock markets or precious metals and commodities.
These cycles, they're always instigated with a recession, a market downturn. The more severe the market downturn, the more strength it gives to the capital rotation. Often you could see it as and we have a chart later on covering the debt, the government stimulus programs, bailouts, etc. And that fuels, on the recovery side, it fuels precious metals.
And this chart here, it's the same gold versus the stock market, gold versus the S&P 500. But what we've done on here is we've labeled the CRE, the capital rotation event. So you can see around about 1970, 71, 72, the chart started to move upwards very strongly. That was a capital rotation event with gold outperforming the S&P. Gold was pegged at the time, of course, during the early stages of that process. So hence probably the V shape to that capital rotation event. The very first one is the 1930 event, and the second one is the 1970s event. The third one is the 2000 event, and then the fourth one there is the one that we're experiencing at the moment. So this is the fourth capital rotation event in 100 years. It is a 100-year chart there. And what we've got on the bottom is the stock markets, the S&P 500. So in other words, what did the stock market do when we had these capital rotation events? And you can see, following the first one in 1930, we had 25 years before the stock market made a new high and began to move up to new all-time highs. And then again, in the 1970s, we had 8 years to make new highs. And in fact, it was quite a bit more than that before it made new highs and sort of reliably held on to those highs. And then the more recent one in 2020, we had over a decade where the S&P 500, the US stock markets, did not make new highs. So when we talk about capital rotation, it doesn't mean that there is no capital in the stock market. It doesn't even mean that the stock market isn't going up, because during these capital rotation events, the stock market does go up. It'll fall maybe 50% over the course of a couple of years. And then what happens is that the stock market starts to grind higher over the following several years. And it takes lots of years to get back to where it originally was, during which time the gold bull has already burst out of the gates and is outperforming the stock market by multiples.
And I was going to say, and that's even in nominal terms, right? So like taking 25 or 8 or 12 years for the S&P to recover its previous level, that's expressed nominally. So when you account for inflation, you're really backwards if you're a stock.
Yeah, I try. I mean, there is a counter argument to that, of course, is that, you get dividends from stocks as well. So, I haven't done the math, but maybe it roughly balances out. But the point, and of course, we're not even talking about gold stocks here as well, and silver, because if gold is outperforming the S&P, then we know that on the recovery side, silver outperforms gold. So gold might go up 400 or 500% on the recovery side, but silver will do 1,000%, and the miners can do more than that. So it goes back to what we said before. Knowing what these capital, what point we're at in these capital flows is critically important, and spotting the relationships between the stock market and precious metals and gold, which is the barometer of all of this, that tells you where you should be putting your capital if you're investing over a period of a few years.
Yeah.
And it also helps you with your trades as well. This is the capital rotation indicator. If you're looking at this on a small screen, you'll see a sort of matrix in the top left-hand corner there. And what's in those red boxes is money supply, which is in a bear market, US money supply versus gold. DXY is in a bear market versus gold. Then we've got gold breaking out versus CPI, PPI, currency in circulation, the equal weighted S&P, NYA, which was the New York Composite, the Dow Jones, the Wilshire, the Russell. And gold is breaking into a bull market versus the S&P and NASDAQ at the moment. And there's a little bit of a caveat on that. It probably just needs to fall a little bit further to give ultimate confirmation.
So you gotta always look at the evidence through multiple facets. And you'll see a recurring theme there is, yes, SPX, we price in fiat, but once we have a capital rotation event confirmed and the SPX and fiat enters a bear market, you have to start pricing everything in gold. Because if you're in the capital rotation, after capital rotation event, gold's outperforming, like those first charts we showed you, gold is outperforming the stock market. What's the use of comparing to the stock market? What's the use of comparing to fiat? You got to take whatever instrument you want to invest in, whatever a miner, let's say Wheaton, price it in gold. Is Wheaton outperforming gold? If so, you got all the tailwinds you want, less headwinds, and you'll have a higher chance of successfully having a good trade.
And that change of mindset is crucially important, because I think people are used to looking at their stock and whatever it is they're thinking of buying and identifying if it's an outperformer. Is this stock that I'm thinking of buying, is it outperforming the S&P? And I think people are probably quite used to doing that. But what they're not used to doing is identifying, well, hang on a minute, gold is outperforming the S&P in a 10-year gold bull era. So everything that I'm contemplating putting in my portfolio now needs to outperform, not the S&P, but gold. So on a ratio chart versus gold, it needs to be going bottom left to top right. If it's not, just buy or have exposure to gold or silver. So it's that change of mindset. You throughout your whole investment career, you only need those two things: gold in the one hand, stock market in the other. And then what am I about to buy? Is it outperforming whichever of these two it happens to be in a bull era? And that's the Rosetta Stone to long-term investing.
Yeah, I like that a lot. And that's actually the way I learned that lesson was actually from studying Bitcoin. Actually, both those lessons, speaking of confirmation bias and finding the right benchmark, is like the whole Bitcoin journey for me has like helped with so many of the things that you're talking about, like trying to prove myself wrong and just trying to prove myself wrong with every theory I had. And then I did that dozens and dozens of times. And that's actually how I came to believe in Bitcoin, is from thinking that it, wastes energy, all these other criticisms, right? And then in terms of finding the right benchmark, I was interested in altcoins. And then I realized after a few years, like, wait a minute, like, this altcoin's doing 10% on average or whatever it is, but it's underperforming Bitcoin. So that's how I started to think like, okay, I shouldn't be measuring my portfolio in dollars. It doesn't make any sense. I have to, pick whatever the best performing asset is at any given time. And so then I moved into gold thinking, okay, what's my net worth measured in ounces of gold? And am I outperforming what gold is doing? And I think that's a big important shift for people to make, but it's tough to get there.
Yeah, and using things like the gold-silver ratio is analogous to using the Bitcoin dominance chart. I mean, Bitcoin dominance is representing market share of Bitcoin, and the gold-silver ratio is representing the strength of gold versus silver in a gold bull market. So these ratio charts, they might scare people a little bit, and they might look at a ratio chart and try and sort of be a bit scared by not understanding what it means. But here we've got a ratio chart of Bitcoin versus gold. Now, clear your mind of all bias, okay, because the bias ain't going to get you anywhere. We've got the 50-week moving average, and we've got the Ichimoku cloud on there. And the Bitcoin versus gold chart has fallen below the 50-week moving average, and it's fallen below a support line that goes back to 2013. So that should set some alarm bells ringing, no matter what your bias one way or the other for gold and Bitcoin. So we now know that for Bitcoin to regain its bull run versus gold, and for Bitcoin to be preferable to have your money into gold, you should be getting above that moving average and above that broken support line. If it can do that, then it should go much higher. I mean, Bitcoin has fallen something like 38% versus gold since it hit that barrier.
It's all about time frame. You got to really see the time frame. But now, objectively, that chart is below that moving average, so it's in a downtrend as defined by that moving average. But it's also gone sideways since 2021. So you could also say, yes, there were bull and bear cycles since 2021 for gold versus Bitcoin, but it hasn't outperformed gold since 2021. It hasn't gone above those highs. It hasn't. So the momentum right now, it's flat right now. It's when the aggregate of market participants realize that it's not going to be a random 5 or 10% correction for the SPX. It's going down 30, 40, 50. It's that mindset switch that happens. And then there's a recession that's in hindsight that they backfill. That's what the CRE is. It's that paradigm shift type of event. So CRE in the 2000s, SPX drops 50%, price in fiat. Price in fiat, then another drop. It can't get any traction for 10 years. But look, I overlay Bitcoin chart. The ebbs and flow of Bitcoin tracks practically the SPX. Of course, it's outperforming SPX drastically during that period, but it tracks from bottom left to top right, it tracks the SPX. So if we think we're going to enter, if you're pro gold and you think the CRE is going to happen and gold's going to outperform SPX for the next 10 years, what do you think is going to happen to Bitcoin here? You think it's going to double, triple, disconnect? That's not like playing the probabilities, right? It had 15 years to disconnect, guys. It had 15 years to do it. It hasn't done it so far. So the burden of proof is on Bitcoin, but people think it's going to dislocate from the NASDAQ. The burden of proof is on Bitcoin, but it's, as chart traders, you're playing the evidence and the odds. You're playing correlations, not causation. You're playing current correlations, right? And you have to accept that a correlation that long has a higher chance of continuing than not continuing, right? It's like assuming all market participants are wrong, right? And you're right. It's like there's a lot of money there flushing out there, guys. You got to respect how the market is carving out the price charts. And it's going to be tough, right? Doesn't mean Bitcoin could do great on the recovery cycles, but it shouldn't have as much traction as it previously did in a bull era for the stock market. I'm sorry, like I know I'm going to get hate for this, but I try to show people this because everybody looks at Bitcoin inception, but they don't realize that these cycles, like all the noobs, even like how many traders have seen the 2001 rollover? Like I was barely understanding what was happening there. And I remember back in 2001, I was starting my IT career. A whole bunch of people were about to retire. I remember these guys making a whole bunch of money in the stock market, and hopefully they're not working today, but they didn't understand that there was a capital rotation event and the stocks were getting the rug pulls. It's tricky, you know. You gotta look at the big picture, guys. And big picture is that gold to SPX chart.
This is global liquidity, money supply rising. Now, I've heard a lot. We've all heard a lot recently that, oh, global liquidity is about to go bonkers. Rates, the Fed are going to bring rates down. Well, neither of those things stops the stock market falling. If you look back at the Fed funds rate, which is another chart we we could bring a million charts up, but when the Fed funds, when a rate cutting cycle is in progress, oftentimes the stock market falls. I know there's this narrative that it goes up, but that's not the case. And this is another sort of narrative that we need to sort of dispel, really. Rising global liquidity does not stop you having 16, 15 lost years or a decade lost in the stock market. It's not a case of, oh, liquidity is rising, so therefore stock markets and Bitcoin are going to go bonkers. It's a case of, okay, there's more liquidity being pumped into the system, but where the heck is it going? And that's where the capital rotation event comes in. Is it going disproportionately over there, or is it going disproportionately over there? I mean, we haven't even spoken about the bond markets either. I mean, I think probably everybody is expecting 10-year yields to be down at 1.5–2% at the moment, and they're proving to be very, very resilient. And it's because we've had a paradigm shift.
This guys, I know Kevin talked about global liquidity, but this is the chart where I found which tracks best these capital rotation events, the capital rotation process. And often, guys, you'll notice from charts that go from bottom left to top right, and people say, oh, the debt's crazy. Look at that. In 1966, this is the total public debt. This is the government debt. It's the money has to borrow, the programs. It's everything the government borrows. 319 billion in 1966. Today, 35 trillion, maybe more there by the time this gets updated. And people say, the debt, and then they go into gold and all that. That's not just a reason why you should do it. Look at the bottom. The bottom is the distance from the 6-quarter moving average. So again, like you saw in the other charts, I'm looking at the accelerations and decelerations in that debt creation. And that's what the market participants react to. And those green overlay lines, guys, those are recessions. And check it out. When the momentum, as defined by the distance from moving average, the debt accelerating faster, because it's practically always going up, goes upwards, guess what's happening? Stimulus programs, a whole bunch of stuff. Recession, bang, 1970. 1974, bang, recession. 1979 or 80, recession. 81, 82, recession. 90, recession. 2001, recession. 2008, recession. 2020, recession. Every single time you have an acceleration in total government debt, public debt. And guess where we are now? It's not stretched to the upside. Often the gold bull eras, they end when the debt has already exploded and it starts unwinding. Look from the 1982 top all the way to the 2002 bottom in the debt. Debt kept going up, guys. But that unwind in momentum, that was the crazy bull era for stocks, right? 1982 to all the way to 2001. But now we're flat. And if that line there where I wrote recession is more likely above this line, and then I have gold, silver, oil, miners outperform above that line, and I have SPX, NASDAQ, Bitcoin underperforms above here, well, the evidence has shown me this is the logical roadmap. As soon as we start closing above that line and the government starts taking on more debt, it's more evidence that the CRE is upon us and we're in a gold and silver bull era.
Analogy for that, you could imagine the car going forwards at 50 miles an hour, 60 miles an hour, and that's the debt, constantly increasing. Put a cup of coffee on the dash of your car, and if you suddenly hit the accelerator, the coffee falls over. Well, the coffee falling over is the capital rotation event. It's when the accelerator is slammed on or the brakes are slammed on, it causes this event to happen within the vehicle, and that's what that's how we can better identify these turning points.
It almost seems like Trump is pushing both pedals. He's pushing the gas and the brakes. He's like, let's slash government spending, but he's probably going to have to take on a whole lot more debt and spend. So
Alan, he's a symptom. He's a symptom. Yeah. Look, these charts there. Gold broke out in June of 2019. It's like it's a macro cycle already in motion. It's like I don't want to say it's guaranteed to happen, but everything's been building up to that. It just happens that the .com, whatever, the GFC, it might be the Trump tariffs this time. Like, of course, as humans, we're going to want to rationalize this and put a headline like on top of that, right? So, Trump is less. I don't know. I think he's just a symptom to all of this there.
Yeah, I agree. Some friends of mine asked me, who are you voting for? And not even the most recent election, it was even prior. And it's like, I said I wouldn't wish the next presidency on my worst enemy,
That's right.
because the economic landscape is so bad that whoever, the next president is at any given time, it's like they're going to get blamed for like a horrible, horrible crisis that isn't their fault, that's been decades in the making. So I agree, Trump is a symptom of these underlying structural issues.
Yeah, decades in the making from parties on both sides of the aisle. It's been a long road to where we are now, and it's sometimes referred to as the fourth turning. You get these huge events that come along probably once in every human lifetime, but it's there's a lot of factors that have to come together, and you can't pin it on any one particular person at any one particular point.
You know what
in
the
time.
common denominator is, Kevin? Okay, I don't want to go conspiracy there, but the Fed or the
Yeah.
government, the Fed and the government have always been there since these cycles. We've been observing them, right? They're the common element in all of this.
Fiat.
Yeah. And talking about that, we've got the gold chart there coming up next, and the gold chart actually delivered a serious warning signal a couple of times relatively recently. Actually, we broke out from that cup and handle pattern there back in was late 2023, I think it was, and we broke above the 2000 level, and then we more recently broke out through that 44 year resistance line, the red line on the chart there. We got that breakout just a little while back, and that's a major signal. These are major resistance lines that we're breaking out of on the gold chart. And when gold breaks out strongly above not just multi-year but multi-decade resistance lines, it can be seen as something of a warning. Really, it's telling us in a way that something just isn't quite right, particularly when it does it so dramatically. There you can look at gold versus PPI, gold versus CPI, all these other capital rotation indicators. And so what's happening at the moment is gold is stretching way above its moving averages. Okay, we are well stretched above the 3-year moving average to a historic degree. Okay, so what that tells us is that in all probability, gold is seeking out a pretty major top here. It could be anywhere between here and, there's a theoretical stretch target there, anywhere between about 35 and 3,700. Whether we have enough time to get to that point depends a lot on the stock market, because if the stock market begins to move upwards strongly and breaks out into a melt-up scenario, then it's risk on and gold sells off. If the stock market breaks down below the critical support line, that's not much lower than current prices, then I think there'd be a bit of a panic, and again, gold and precious metals would sell off. Now, this is normal, because we're very stretched from the 3-year moving average. So we want and we need the sentiment to reset to power gold higher. And you can see a roadmap there where gold does roll over at some point in the next few weeks probably, and comes back down to perhaps, just an estimation, but perhaps somewhere around 2,800. That would be an opportunity for stuckers in particular. In fact, anything below $3,000, however brief it might be, is likely an opportunity. And as we are in a position to say that capital rotation event evidence is as strong as it is, then the high probabilities are that gold would then recover from that, particularly after stock markets bottom, or as we move towards the stock market bottom, gold and silver would start to move up, and silver in particular would outperform. So there's a roadmap there to $5,000-6,000, pull back, and then move up towards $8,000 to $12,000. And I think an $8,000 to $12,000 target, within the next sort of 5 to 8 years isn't unreasonable.
Yeah, it's guys, we're pricing stuff in fiat. They're just adding zeros, and nothing's gonna break, guys. As like people, it's gonna break. No, we had gold at $25, we had gold at $200, we had gold at 1,000, at 2,000. Nothing breaks as long as it doesn't go up too fast. It's like, it's not the end of the world. They're just, that's how they're destroying your purchasing power. But Kevin touched a good point there. Gold and silver, people want to know when are they going to start outperforming? And this is a chart there. It's the gold silver chart. This chart exemplifies when how does silver behave? When does silver have its best runs? So silver starts outperforming gold when the stock markets start recovering from a severe drawdown. Remember, I said destruction of purchasing power required to save the US equities. Silver loves that. Did that in 1975. It did that in 1982. I think it did it halfway through that bull era in the 1970s. Look in 2002, the stock market went down 50%. Exactly when the stock market started going back up, silver started outperforming gold. And guess what? Silver outperformed gold pretty much during that whole run for that 10 years, except the GFC, where there was another reset where silver got dragged down versus gold. But look at that, the exact bottom, 2009, silver started outperforming gold, and it outperformed practically everything. I went through a whole bunch of charts, Alan, trying to figure out what outperformed silver. There's not much, maybe Cameco, a few uranium, like silver. If you're beating gold in the precious metals bull era, there's just practically nothing that's going to beat silver in the major asset classes. Of course, I could find some occult micro cap. There's always stuff breaking out, like outperforming, but in the major big boys, silver is a great play after the stock market's bottom. So CRE event, and the harder the SPX corrects, if it goes on in a 50% bear market haircut, my goodness, as soon as the market's bottom, silver probably nominally is going to already start going up before the market's bottom, but its best years, its best performance, it's lock limit days that are like always going higher and higher and higher. They're after the market's bottom, not before.
And we're in a great position to start seeing that happening because the gold-silver ratio is already pretty high. It's up near 100 somewhere. Now, you can imagine in your mind a scenario where we do have this correction for the precious metals, and therefore, in a correction in precious metals at the moment, you know that silver is going to get hit hardest. So what's that going to do? It's going to put the gold to silver ratio higher. This chart that we're looking at now is the silver to gold ratio. So what it's going to do is push it lower. So this ratio chart that you're looking at on the screen now is going to dip even lower. What does that do? Well, it sets you up even better for don't hesitate to use the word violent, but a rapid, large upside move in the silver to gold ratio. So yes, silver has been going up. It's gone up from $15 to where we are today, over $30. Silver still goes up even when it's not outperforming gold, but it's glory days, they come when the stock market has bottomed, as Pat said. Right. So wait for the S&P to fall 40-50%, and then right, I'm going straight into silver because it's going to go up 1,000%.
And those eras that you flagged in that chart there, where silver does outperform gold, it looked like they ranged anywhere from 2 to 5 years, where silver outperforms gold each time. Is that about right?
Yes. Well, yeah. So 2003 all the way to 2007, about that, before the GFC, and after that it had another one. So those are halfway cycles. Yeah, it could be that run. At the end of the day, we're just going to look at the charts, but yeah, it's going to run hard. It's going to, like Kevin likes saying, it's going to double again, and double again. Each of those runs, Alan, there, silver went up about 400%. So that's 400% in 5 years, another 400% in 5 years. But using charts, you don't have to hold through a GFC event, right? You could try to exit there and then get back after the market's bottom.
So the target that we've been showing since this chart went out 5 years ago is, well, you can see where the target area is in time and price. It's that 38 to 50 zone. Once silver spikes above 32 and then 35, your guess is as good as mine as to exactly where it'll stop. It could be 40, it could be 50, it could overshoot and go to 60. You know how spiky silver is when it gets into one of these moves. But that is just the beginning of the journey, because from that point a correction would be likely, and then that's when you accelerate. So after stock market's bottom, you're going to be powering way past that target area and on up to $100 plus without even batting an eyelid.
Wow. Amazing. Well, that's probably a good place to end it with a little forecast for gold and silver. So Kevin, Patrick, thank you guys so much for being here. I really appreciate it. If people want to follow your work, where's the best place?
Yeah, you can find us at Northstar, Badcharts.com. We've both got X accounts as well. Mine is at Northstar Charts.
And Badcharts 1.
Badcharts 1. Awesome. Again, thank you guys for being here. Really appreciate it.
Thank you, sir.
Cheers a lot.